Hello, welcome to part 2 of balance sheet. Now, in this class, we will learn about few concepts. Concepts based on balance sheet. Concepts which will help you identify whether the balance sheet of one company is looking healthy or not. Concepts through which you will be able to decide whether one company's balance sheet from the same sector is better than the balance sheet of the other company or not. You know, better, or where exactly the differences are. Yes, so why I always talk about differences is because in this course, complete course on Indian stock market, which I have named and which you are attending right now, I am focusing a lot on relative valuation. So let me remind you a few things. Point number one, you are going to do relative valuation where you will identify whether this company is better than this company or not. Point number one. Yes, you will do some intrinsic valuation as well, which means that if certain capital is deployed in one company, whether this company is generating enough return or not. And then obviously you have learned, if you understand that what return is getting generated on a capital, and if you know how to calculate that, you will be able to forecast the growth of that company or that asset class. This is how we started this quantitative part of the fundamental analysis. So this is what I wanted to remind you. Hope you remember that. Multiple choices you had to put your money at different rate of return. And then immediately I told you about profit and loss statement, because I wanted to tell you that how much money one company is making. So one company may be making 500 crore profit in a year. Another company is making 700 crore profit in a year. And you need to know that to calculate the percentage of return on the capital. Correct? So now you have to start connecting your dots, these dots which you have learned. Then only you will be able to draw some conclusion. So in a way, what we also have to learn is clubbing profit and loss statement with balance sheet. Yes, we are learning 3 financial statements. There are 2 more which are not that important, I would say, at this point of time. I'll include about them in the reference section, the other 2 financial statements. But at this point of time, when we are learning these 3 financial statements, one which you have already covered, profit and loss statement, another which is a balance sheet, which we are covering right now, and then we will go to the cash flow. So at this stage, at this juncture, we will club both profit and loss statement and balance sheet to draw some sense out of it, so that we can take some aware decision, because investing into stock market is about making aware decision, not looking at the stock price, but looking at whether this company deserves that stock price or not. And for that you have to have numbers in hand. So yes, profit and loss statement, you know that some company or any company which you are going to analyze is posting profit or loss. And there I asked you to remember one thing, that something as a value investor, you must have to remember that company growth will be measured by not only the sales but also the profit. And this growth should be exponential, which means next quarter profit should be more than this quarter profit. And it will only happen if the sales is also increasing. Sometime with stagnant sales also, you may say in a 1 or 2 quarter profit has increased, because might be in that quarter company has bought some efficiency in the system by bringing down the cost. But overall, in a very generic way, yes, you have to remember it, and I'm sure you remember it, that the sales growth should be there on a compounded rate. The profit growth should be there on the compounded rate. Do we need to also remember something like that in balance sheet as well? Yes, you have to. So this is what we all will learn in this segment. This one piece which you need to remember, the way you remember from the profit and loss statement. Though only on balance sheet, even if I create 50 hours of content, it will be less, because it is such a wide or vast subject. People who have done CA, they must be knowing it. I mean, you can simply flirt with balance sheet. If you're really in love with finance and numbers, you can keep flirting all your life with balance sheet and still your knowledge will be less. But then my job is to first make you aware, and your job is to be aware in the most simplest form and remember few things, so that even in a glance of 10 seconds you can see few numbers and decide whether you have to go deeper into it or not even, right? So I reminded you few things, and I'm giving you one agenda. That's something you have to remember. I'll go and cover about the balance sheet first, and then I'll tell you what you need to remember. However, this class on balance sheet or profit and loss statement or cash flow is again a never ending process. What we will keep on doing is analyzing a lot of balance sheets, and we will keep including it. So I do doubt clearing sessions, I do live webinars, and now one of you will be attending that live webinars as per your schedule. So we will analyze a lot of balance sheet, and we'll keep on attaching that into the course, so that you can keep on coming and checking whether any new balance sheet analysis has come or not. However, the basic format is something which you need to remember, and I have explained you that in the part 1. So without wasting much time now on the philosophy part, obviously this was philosophy part, but then this is the most important part, because number, structure, everything you will remember. You can go and check any balance sheet, and or you can watch any video or any book, and he'll tell you that what exactly is the balance sheet. But then every individual who have been an investor, he has his own way of looking at certain things, and he must share his experience with you. And this is what I'm doing it through this course, not going in a very bookish or structured manner, but always trying to give you, at least I try my best, that how do I look up to it, how do I see things in it, what are the conclusion I have to make out of it, and then I tell you my perspective, my way of looking at these things. You have to develop your own stuff also, your own way of looking at things also, right? So coming to the balance sheet now, what we will do that we will use a screener only, because on a screener what happens that profit loss statement, balance sheet, everything comes on the same page. So since we are going on a very preliminary level of understanding the balance sheet and doing some analysis and remembering a few facts, we'll keep the simple platform only instead of taking the real balance sheet or profit loss statement of any company. So I told you in last class about that you have asset is equal to liability plus shareholder equity, or equity plus liability. However, the name suggests the balance sheet means things needs to be balanced. You needed one statement from where you can tell the world that how much you are selling and how much profit you are making, and then you developed or invented or formulated profit and loss statement. You also needed one statement where you can tell that what this company own and what this company has to give, right? So let's say for your own home, you wanted one financial statement, what all stuff you own. You own a house, you have gold jewelry, you have car, you have bike, and then on the other side, what you really want to also write is how much loans you have taken, how much money you have to give, right? You always keep a note of it. That's your balance sheet. Now the company's balance sheet are little different here, where the company says that I cannot, first of all, not only individual, no one can say asset is equal to liability. If you make asset is equal to liability and you match them, means whatever you have taken it on loan, nothing belongs to you. So if nothing belongs to you, your net worth is zero. So to identify your net worth, what you have to do is subtract asset, subtract liability out of the asset. You got 1 crore of house, 50 lakh rupees loan, 50 lakh rupees is your net worth. You will remember it, right? Right. So asset is equal to equity plus liability. However, when you remember that you have to balance them, you must be thinking about one thing, that I have heard always asset is equal to liability is what the balance sheet. Then what is this equity part doing here? This is what I'm going to focus a lot today in this class, and you have to be with me and look at this thing. So let's jump to the balance sheet and try to understand one thing. So things needs to be balanced, and look at this number. This is balanced. 1,27,335 crore. 1,27,335 crore. This is called total asset, and screener is writing it total liability. Now the point here is why screener is writing it total liability. Why this reserve and share capital is on the side of the liability. And to answer this, I'll again remind you the very basic class, the very first class, in fact, when I told you the purpose of this stock market. So one company raise fund through two ways: debt and equity. Debt is means they can take loan, and equity is means where they dilute the shares of the company and raise fund from the public or whomsoever who want to become the partner of this company. However, every company gets started by some promoters, and these promoters put some money in the beginning. They run the operation, they make money, and then after some time they go to the public and raise some fund. Well, when they raise fund through the equity, when they means who? Company. Now company and individual are two different entities. That is why it is called private limited company or the public limited company. Means this company and the promoters have limited liability on many junctures, right? So when a company raise money through debt, they have to pay it back. But when they raise money from the people, they do not have to pay back in the same form of cash. Means they have taken 10 lakh from bank, they have to pay 10 lakh. But when they have taken 10 lakh rupees from the public, they tell them that we make you partner and I will not pay you back the same 10 lakh rupees in the same way. But then the money which they have taken, they have a liability. They consider, the company has to consider this as a liability only. Even if they will be not forced to return the money, the moral liability is there with the company. And what is the moral liability? The moral liability is to stick to the words. So when you are bringing the IPO, you are giving word to your public. What is the word you are giving? You are giving that, boss, I have been making money for this company. This company doing these activities have been making money, and I'll keep on making money, more and more money. And then it will result in making this company a bigger company. So the share prices will rise, and that's how you will make your return. So I will not return your 10 lakh rupees and 8% interest, but what I am committing you is that this 10 lakh rupees will become 1 crore or even 10 crore, because we are on a growth path. So even the moral responsibility what the company have, when they create it on a balance sheet, they put this part also on the balance sheet side, on the liability side. So what are that? So first is all the money which they have raised or the promoters have, put into the company bank account when they were starting. You call that simply share capital. Simple. Now, share capital is the money what the people who have formed this company or the new investors who have got into the business and became partner is the share capital. Now company has started making profit. Now when companies started making profit, they can tell their investors that we made profit and we will give you some part of it. What is that name? What is the definition? The definition is dividend. So yes, the money which has been now created by the operation within the company operation of last year or 1 + 1 + 1 year, company can simply return this money to the shareholder and say that you put the money to make more money. I as a company have done exactly the same thing, made this money and keep all the 100%, because anyway company belong to you. I had a moral responsibility to make more money on your money and give it to you. So here is the profit, you keep it. And individuals who are the shareholders of this company, they will keep this money. That's what we can say, that company has distributed 100% of the profit in form of dividend. But then companies don't do that. Companies are not supposed to do that. Companies should reinvest that and grow the business, because if they don't reinvest the profit back into the business, the compounded sales growth or the compounded profit growth, what we remember from the P&L statement, which is must required for value investing, will be not achieved. So when that will be not achieved, obviously company will not grow, and it will become like a fixed instrument like FD, that every year company is making 10% profit and distributing it among the shareholders. And after some point of time, all the assets which they have created may get decayed. So even their profitability will go down. So this money needs to be used to maintain the business, to grow the business, So they create a separate account for that and they call it reserve and surplus. So whatever money is left out with the company, they put this as again as a liability part and say that, okay, I'm keeping it in the bank account, but this don't belong to me. I'm one entity, hypothetical entity, created by Government of India with some approval, but then this money belongs to the investor, so I'll still put it into the liability side. So share capital and reserve keep on increasing. These are the method of representation. Obviously the money will be there in the form of the liquid asset, cash, but then when they prepare the balance sheet, they put it on the liability side under the head share capital and reserve. Now something which you have to remember here is this should keep on increasing as well, because this is the real net worth of the company. If company gets closed today, if all the promoters, board of directors and every shareholder decides to just wind up this company, what they will be left out with? The assets which they have created will be sold, the liability will be paid, and more or less the money which will be left, not exactly the same, but more or less, as I said, approximately it will be all about the reserve and the share capital which is there in the form of liquid assets, because this is what they have made out of the operation of all their business. So this is what needs to increase in form of TCS. You can see that their reserve and surpluses keep on increasing. Share capital will increase or decrease only when, when if company is going for a buyback or bringing more IPO, the further follow-up IPO. So in that structure only, some portion will get diluted, sometime stocks get added, and so there will be hardly minimal change on the share capital side. The major difference you will see will be on the reserve and surplus side. And another principle of value investing which you have to remember is that reserve and surplus should keep on increasing, because if the sales is increasing, if the profit is increasing, if the sales is increasing, profit will increase, and that will result in increasing the reserves of the company. That will be also called the net worth of the company. Asset minus liability will be the net worth of the company. This they are writing as a total liability. However, it should be called liability plus shareholder equity. I'm not saying a screener has done any mistake, because this is how people always remember and refer. that this is the total liability, but what you have to remember is this liability, borrowing and other liability, is something which you have to sum, and you have to subtract it from the total asset. If you go and check the real balance sheet, you will see that there are many different other heads on the liability side and asset side also, and they are categorized in current and non-current asset and current and non-current liability. I'll not go there right now. I'll go on these heads when we will be doing more and more ratio analysis, because in those ratios it will be okay. So again, I just want to give you a recap here. Profit and loss statement you have understood. You know what is the net profit. Now what you have understood is through balance sheet you come to know about the net worth of the company. Obviously this is the market capitalization which you understand, but then in other way, that what exactly is company is having its net worth, the actual worth right now. They are demanding a premium in the market, their share prices are high, market capitalization is high, but what is the net worth of this company? How much money will come out of this company if this company gets shut overnight? This is that money which you have to pull out, these numbers you have to pull out from share capital and reserve, and you have to remember it always, that it should increase. The biggest challenge for me while creating this course is I always want to come in every lecture that I should give you one message, that what is you have to remember and not get confused, because so many different heads are there. I know this is a basic course. A lot of people who are attending this course or going to attend this course is not having a detailed understanding about the balance sheet. And that's why I try to keep it simple and try to give you that at least remember one concept out of every lecture. Okay, so from this lecture you have to remember this and you will remember it. Now the future. So in future we will learn about the cash flow statement, and then we will learn about the ratio analysis. So at that point of time, since there will be many different kind of ratios, we will deep dive into balance sheet also and cash flow also, and learn few more things. But at this point of time, just remember this, that you will pull out the net profit of this company and pull out reserve and share capital, and then you will come to know that how much percentage of return one company is making out of the capital which is deployed here, or the capital which is present there, or the total shareholder fund or shareholder equity, whatever you call it. But the crux is one thing: if company gets liquidated, some money you will get in hand. That money you can go and put it into FD. Will that money give you this kind of return? If not, it is okay to give some premium to this company. Means even if the book value is 253 rupees, you are giving 1759 rupees, which is like almost 4 times, sorry, not 4 times, 6-7 times premium. Why you are giving? This is the reason why you are giving. Because see, this company is having just 89,000 plus 300. It's like 89,000 and 400 crore, 450 crore kind of money. But out of that, how much they are making? They are making 31,472 crore of profit. And that is why I wanted to put you here on the screener. So what you can see, that it's almost 35% of the return they are generating. So it is not a wise decision to close a company which is giving 35% return on the capital which is deployed here. Not exactly the capital which is employed here, but yeah, the net worth. Now this net worth, if you put into FD, how much money you will get? You will not get 31,000 crore, 31,500 crore. How much you will get? You will get 6% out of 89,000 crore, or let's say 90,000 crore, which is how much? Which is not more than 550 crore. So this company should run. This company is okay to demand even 7 times of premium. Okay or not okay? Maybe 7 times is too high. Maybe 7 times is still too low. Okay. So what you need to basically now do is see every balance sheet in respect of that sector. because not every company will demand this kind of premium, and some company may demand even a higher premium because their rate of return, this return on equity, by the way, they display it here. I didn't want to tell you about the ratio analysis first, because what happens that there is a lot of misconception in the market around ratio analysis. Some people make a definite rule that if P is this much, stock is good. If ROE is this much, it is good. If ROC is this much, it is good. And so many numbers they create. But then you do not have to mug. In our engineering college, we had a say that people who just go and try to memorize everything, we used to call them maggu. So you do not have to be a maggu. Your concepts should be clear. Okay, it is irrespective whether you understand ROE or not. What you have to remember here is that you know how much profit this company is making, at what capital, at what shareholder fund, and then only you will compare it with either FD or some other company. And this is what you have to remember. Now that I told you that why ROE should not have any definite rule, that 35 ROE is good or 30 ROE is good or 40 ROE is good. Yes, on a very first glance it may look that 35.98 ROE is good, but then you have another company which ROE is 40%. Is it 100%? Can we say, if we just mug this concept, can we 100% say that a company with ROI is 38% is good company or a better company than TCS? Maybe that company is, let's say, Infosys. No, we cannot say. I'll tell you one example. So let's say company is having 100 rupees. It made a profit of 20 rupees and it distributed all the profit, and they keep on doing it for the next 5 years. Then the ROE percentage will be how much? The ROE percentage will be 20. Now there is another company. They keep on adding that profit in the reserve and not giving dividend. However, the profit is still increasing. From 20 rupees, it is increasing to 22, 23 rupees. Or even it goes to 25 rupees. But the problem here is they are not giving dividend. If they are not giving dividend, this reserve, it will keep on increasing from 100 to 120 to 140 to 160. And when it will keep on increasing, what will happen? At one point of time, you will see that the company is maybe posting only 50 rupees profit, but then the reserve and surplus has grown to 200 rupees, right? Or it is not posting 50 rupees, but posting 35 rupees of profit only on the comparison with the other company. And ROE is only 17.5%. So ROE is less than 20% for that company which is giving more dividend. But then we cannot very clearly say that this company which is posting only 17.5% of the ROE percentage is inferior to the other company which is posting 20%. Because it's directly proportional to the reserve and surplus. If you keep on increasing the reserve and surplus, sometime maybe ROE percentage will come down because your denominator is increasing. And on the other side, one company may never want to keep this reserve and surplus and keep on sending out all the profit to the shareholder pocket. In that case, they will be giving good dividend, but then it also shows that they don't have a clear growth strategy. They are distributing the dividend, they don't know where to go, where to expand the business, where to do more acquisition or not. So these are some basic things you have to right now understand and also visualize and remember it for always. That yes, I'll go with the ratio analysis. I'll understand all kind of ratios, efficiency ratio, profitability ratio, all kind of ratios. But then I'll not become a maggu. I'm sorry, I'm taking this word. Some people should not get offended who are taking this lecture. But yes, you do not have to be a maggu. You have to very simply have your own way to finding out things, and then you should have a way to comparing things line by line. Now, since I'm talking about the comparison, why not we compare the balance sheet of one company to another company? Okay. So let's say we take the Reliance Industries. Now what you can see here is they're almost same kind of company, I mean same market capitalization of company. 7,50,000 crore, 6,60,000 crore. 1 lakh crore difference, 20% here and there, but both of them are very large company, well audited company, respectful company, and I'm not sure. I mean, every time I take examples, whether you people draw some conclusion, you would draw some conclusion whether you have to go and buy this company. Well, this is, I have to remind you, it will be a purely educational purpose and not a unsolicited advice from my side to buy TCS or Reliance. It is all about creating a portfolio, and in your portfolio, there should be IT company, there should be a petrochemical company or a conglomerate like L&T or Reliance, right? So we will try to see that the formula or the representation or the format of one website of one balance sheet will not will be same in the other balance sheet also, but the numbers will change significantly. Like something which I wanted to show you, if you go and see the balance sheet of TCS, you will see there is hardly any borrowing, and even the liabilities is less. Both of them looks like almost same kind of same market capitalization company. Some of you may have a confusion that okay, asset is something what one own. So I have experienced this actually with the very early stage learners, that they think that okay, if a company is having huge asset, that company must be a big company. But the idea here is companies build these assets by taking liabilities, big loans, obviously by some profit also. So what you need to look at here is, if you see the Reliance balance sheet, you will see a huge amount of asset. 10 lakh crore of asset is there. By the way, I'm showing you March 29 because the March 2020 balance sheet has been not come, so that's why I'm comparing even the profitability with that. So now 10 lakh crore, and what do you see here is 1 lakh 15 crore. However, the share price market capitalization difference is just 10-15 crore. So what do we understand here? We understand here that the way numbers are looking in Reliance is completely different than the numbers what are looking in Tata Consultancy Services. Here you see huge amount of asset, huge liabilities, and then they have a good reserve and surplus also, much bigger than. Now if you cannot just take the total asset into the consideration to determine whether this is the best company or the bigger company or not, or justify 7 lakh crore of market capitalization or not, you cannot independently understand alone. Only see the reserve also and say that this is a good company or another one. So here it looks like that okay, if tomorrow TCS get liquidated, TCS will all have is 89-90,000 crore rupee. However, Reliance will have 3,81,000 plus 5,000 crore, which is like 3,90,000 crore kind of money. Well, yes, it is true, it will happen, but the point here is none of them are going to be liquidated. We assume it to understand few numbers, hypothetically we take these examples, but what you see that it is not that easy to liquidate the assets which Reliance has created. Who will buy them? If they are going out of the business, who will even think about getting into their business and buying their old assets? Whether the other party will be able to manage the whole borrowings and all the finances or the whole operation or not. So companies are not going, companies of this stature or any company, no founder, no promoter, even if they are posting loss, try to close the company overnight. We take that example for the reference to understand numbers, right? So you certainly see that the reserve and surplus is almost 4 times more in Reliance, but this doesn't mean that Reliance share price should go 4 times. So you cannot take a very judgmental call looking at 2 different sector balance sheets. However, if I change it to Infosys, and then if we see the balance sheet of Infosys, what do you see? Similar structure, no borrowing, both are IT company, they don't need. Reserve plus surplus 62,000 crore, here 89,000 crore. But then it looks similar, but then you have to again go and take the efficiency of Infosys in terms of how much money they are creating out of it. 15,000 crore. So what you can see that TCS return on equity is much higher than Infosys. Infosys return on equity is 23.5%. But is it enough to again make out a conclusion that Infosys is not better than TCS and you should buy your shares on the TCS? Well, nothing is enough. You always have to take assumption, and on this note I would like to close the chapter. Whether you do intrinsic valuation or relative valuation where you compare two companies, different numbers, whether you put across their balance sheet, profit loss statement, and even the cash flow, the business is so dynamic that there will be still many factors which will be responsible for one company growth and another company decay. So that's why you always have to take a wholesome approach. You have to do the qualitative analysis, you have to be aware about these numbers, and then take a judgmental call. You may be wrong, you may be right. The stock which you have chosen maybe in first 6 months, 1 year would have not given you the desired result, or its competitor has given more result or the better result. Something what you always have to remember, that you have to first create a conviction over that stock, that company, management, and then you have to be aware about these numbers. Well, I don't want to discourage you here by saying that even after knowing all these things it is not enough. No, what I'm trying to tell you here is that independently just one analysis will be not enough, and you have to cover as much as you can. And when I say you have to cover as much as you can, the another last thing which is left here, where again we will learn few things about the health of the company so that we can compare it within the same sector and also independently, is the cash flow statement. So let's go to the cash flow statement and try to understand what is the meaning of cash flow statement and what is all that you have to remember from the cash flow statement, and how to club balance sheet, profit loss statement and cash flow to be wiser in terms of taking our decision, in terms of becoming more aware for taking the decision. Don't get discouraged by my words. I might sound sometimes very pessimistic in terms of telling you that even after learning this much, probably this is not enough to identify a good company. The only purpose behind is the only message which I want to give you is there is no end of learning, there is no end of research. I might be a very small teacher who is just I might be right now okay, I can't define myself. The only way I can define myself also is like I'm also learning. Even when I'm teaching you, I'm learning. So keep learning, keep flirting with balance sheet. The more you flirt, the better you will become. Thank you.